All right, today we are digging into a geopolitical firestorm that absolutely blindsided the markets, and it all revolved around Greenland. Yeah, you heard that right. So let's get into it. What happens when high-stakes politics and global finance crash into each other?
So first, let's just set the scene. We're talking about a quiet holiday morning that suddenly became the epicenter of this huge financial shockwave. Seriously, nobody saw this coming. And really, this is the central question, isn't it? What happens when the markets panic on a day when they're supposed to be closed? I mean, when the main trading floors are dark and the big players are offline, who's actually in control? And what does that reaction tell us about the state of the whole global economy?
Okay, so picture this is January 19th, 2026, Martin Luther King Jr. Day in the US. It's a federal holiday, right? So the cash equity markets are totally closed. For most traders, it's a day off. You'd think things would be quiet. But under the surface, in that 24/7 world of futures trading, things were about to absolutely erupt.
And here's what happened. Just a sea of red. While the main markets were sleeping, the futures markets, which, trade nearly around the clock, just went into a complete nosedive. We're talking significant drops right across the board. And the tech-heavy NASDAQ, it took a particularly brutal hit. So what was the trigger for all this chaos? Well, it wasn't a bad earnings report or some surprise interest rate hike. Nope. It was a stunning geopolitical announcement, a threat to slap tariffs on 8 European nations, all because of a proposed U.S. purchase of Greenland. I mean, you can't make this stuff up.
And look, this wasn't some vague, off-the-cuff threat. Oh no, it came with a very clear, very aggressive timetable. A new 10% tariff was set to begin on February 1st, just a couple of weeks away. And if no deal was reached, that rate was going to jump to a really punishing 25% by June 1st. Talk about putting pressure on everyone, markets, politicians, you name it.
So let's talk about the reaction. Just how fast and how hard did the market actually plunge? We're going to decode this by looking at the data, the sentiment, and the incredible speed of it all. Okay, look at this number, minus 1.57%. Now, you might hear that and think, okay, that's bad, but it's not a catastrophe. But here's the kicker. That one drop, in one morning, erased all of the gains the NASDAQ had made for the entire year. The entire year. This one event literally reset the clock on 2026 for one of the most important indexes in the world. Now, this is where it gets really, really fascinating. If you look at the market sentiment, the internal dashboard was just completely scrambled. You had some indicators like moving averages flashing sell. But at the same time, other technical indicators were screaming strong buy. So what was the overall signal? Neutral? It wasn't a clear sell everything signal. It was just paralysis. Total, radical uncertainty in action. And really, that gets us to the core of what was driving all of this. It was this sell first, ask questions later mentality. And it wasn't just driven by the bad news itself, it was driven by one thing: radical uncertainty. Nobody knew what would happen next. What would Europe do? Would the tariffs even happen? And when you're faced with that many unknowns, the market's gut reaction is always the same. Sell now, figure out the rest later. All right, so we've looked at the data, but let's peel back another layer and get into the human element here, the psychology of panic. Because behind every single one of those flashing red numbers, there's a person making a decision. And often that decision is driven by pure fear, not logic.
And there's a key concept in behavioral economics that explains this perfectly. It's called loss aversion. Basically, the pain you feel from losing money is psychologically about twice as powerful as the pleasure you get from gaining the same amount. So when investors see their portfolios dropping, that fear kicks in hard. It pushes them to sell just to make the pain stop, even if it's the absolute worst thing to do for their long-term plan.
And here's a quote that I think illustrates a much healthier way to think about all this. Think of a healthy market like a balloon. You don't want to blow it up quickly until it pops. Instead, you blow it up, let a little air out, then blow it up more. It's such a great analogy, right? It reminds us that these little downturns are normal. It's just the market letting out some air, which actually allows for more sustainable growth later. It's a perfect way to think about it and fight that panic impulse. And this really gets to the heart of the investor's dilemma. It's this internal conflict that every single one of us faces. On one hand, you've got your rational strategy, right? The plan you made when things were calm. Stick to it, view downturns as opportunities. But on the other hand, you have that powerful, gut punch emotional reaction in the heat of the moment that's screaming, abandon ship, sell everything. And honestly, the battle between those two sides, that's where financial futures are made or broken. So while all these investors were panicking, every eye in the financial world turned to Europe. What were they going to do? How would they respond to this crazy amount of pressure and the very real threat of an all-out trade war? They called it their big bazooka. And you can just feel the tension here. The tariff threat pushed this long-standing relationship between the US and Europe into a really severe crisis. This wasn't just about money or trade anymore. No, this was a deep political rift, and it was tearing at the very fabric of an alliance that's been around for decades. The implications for global stability were huge. So in response, EU leaders started talking about deploying the bloc's anti-coercion instrument. It's widely known by its nickname, the Big Bazooka. This is basically their nuclear option, a super powerful and, so far, totally untested economic weapon. But here's the catch. Firing this big bazooka is way more complicated than it sounds. It's not like flipping a switch. You can see it's a whole process. First, the European Commission has to investigate for up to 4 months. Then, member states have to endorse it. Then there's a vote. And even after all that, there's still a final round of negotiations. So it's designed to be a powerful deterrent, not a hair-trigger weapon. And that just added another layer of what if to the whole crisis. And that bazooka wasn't the only option on the table, not by a long shot. Europe had other powerful moves it could make. For example, they could reactivate tariffs on things like American bourbon and aircraft. They could slam the brakes on ratifying the existing US-EU trade deal. Or, and this is a big one, they could start making noise about their $8 trillion in holdings of US bonds and stocks. Each of those options carried a massive risk of making things even worse. All right, so let's pull back and look at the bigger picture here. This whole thing points to a really uncertain future where politics is what's really driving the price of, well, everything. And this, right here, is the new reality. This is the key takeaway. Tariffs are no longer just an economic tool. They've become a multi-purpose political weapon. It's not just about trade balances anymore. As this whole crisis showed, they're now a primary tool for achieving purely political goals. And believe me, this isn't just some abstract theory. This has real-world dollars and cents consequences. Just look at the estimated GDP hit from a 25% tariff. For a huge export-driven economy like Germany, you're looking at a negative 0.3% hit. That is a significant blow. And that number doesn't even begin to account for all the secondary effects, like a total loss of business confidence and investment. And that really brings us to our final and kind of unsettling question. In a world where policy tools are becoming multi-purpose weapons, is any market really safe from these political shockwaves? I mean, if a disagreement over a remote Arctic territory can wipe out an entire year's worth of gains for the tech sector, what does that mean for the future? It really makes you wonder if any part of the global market is truly safe from the next big geopolitical surprise.